The past few months has seen a seismic shift in the expectations for recovery for the US economy from the COVID-19 pandemic. Today I'm joined by Richard Franulovic, our Head of FX Strategy, to discuss the key themes and implications for the US economy, the global economy and financial markets. Rich, glad to be here today with you.
Pleasure to be here.
We've had a lot of conversations about this in recent months, both in terms of sort of the initial implications of, I guess, the peak of the second wave of COVID-19 in the US and subsequent to the election, which President Biden has won and now been inaugurated after, about the stimulus package that he's now bringing through. Obviously, a lot has changed. In the last couple of months, I guess what comes to mind is the very significant decline we've seen in COVID-19 cases. From about 250,000 per day for the US down to about 50 or 60,000, which is obviously a very significant shift. And we've got the vaccine drive underway as well, which should drive that further down. And in addition to that, obviously we've had the 1.9 trillion of stimulus come through, which was obviously very pleasing. And it's pleasing in a number of different ways, one of which is that it does provide that necessary support right here, right now for US citizens. So about 20% of that package is going to be in bank accounts of households within a few weeks. That could be $5,600 for a family of four.
Big money. Big
money. And in addition to that, you've got another 20% or so coming over the next 12 months in terms of tax credits, really focused on families as well. So very big, sort of quite positive there, and it's coming at a time, I think it was really important to emphasise, when the US economy is getting back onto its feet already. So this isn't about just filling in a hole, this is about increasing momentum and providing a very strong backdrop for the US economy as we roll through 2021. We ourselves are forecasting growth about 5.5% this year, really driven by the consumer. And we've seen this week the Fed announced that they're expecting growth about 6.5% this year. So I mean we're talking about 3 times potential growth in this year. How have markets sort of reacted to this, and particularly around the US dollar?
Yeah, right. Well, apart from the dramatic lift we've seen in US yields, albeit from very low levels, I think the key message for foreign exchange is that the stimulus is going to secure a very vigorous rebound for the US in the near term and the global economy. And it's that latter piece that I think is key for thinking about exchange rates. A good part of that stimulus is going to leak into the global economy through high US imports. That's going to boost global growth, and that's going to give commodity prices a very good boost. Anything that's good for commodity prices is going to be very good news for commodity currencies like the Aussie dollar. So that's one message there. The other key takeaway I'd add is, as you rightly say, it's going to accentuate the US recovery in the very near term as the economy is reopening. And it's going to make the US economy look very impressive versus the likes of, say, Europe, which is struggling to find her gears at this point. There's extended lockdowns. They've had challenges with vaccination. And so the US economy is going to look quite strong relative to parts of the world like Europe. That should help underpin the US dollar in the near term, but the US dollar ultimately is going to be capped by the Fed's very dovish stance. The other question mark too that is worth putting on the table is, to what extent does this stimulus help sustain growth in the US into 2022? I think that's going to be a key question mark, and it's one that you might want to address there. Do you think that this stimulus will help sustain US recovery into 2022?
Yeah, as I mentioned at the top, I mean, obviously the stimulus money itself is coming to bank accounts very quickly. So that will be used up probably within a number of months, probably the next 6 to 9 months. And so really after that, it's about the recovery that it creates in the labour market. So we're looking for the unemployment rate for the US to end this year about 5%. That's about a third of what the peak was in the middle of the pandemic. So obviously a very significant improvement there, and millions of jobs that go with that decline in the unemployment rate. So if we are accurate in that expectation, and that's relatively in line with what the Fed's expecting as well, then that will give greater momentum for next year as well. If I come back to our growth forecasts, whereas we've got growth of about 5.5% this year with upside risks, next year we're looking for about a 3.3% gain. So that's still, that second 2022 figure, that's still sort of around about twice potential. So again, a very good outcome. I think that's where it starts to think, where we need to start thinking about what that might mean thereafter. So we start to move to 2023 and beyond. And that's where we think there would need to be more stimulus coming if we are to see, I guess, more above trend growth years thereafter. Now, Rich, I know you sort of spent a lot of time thinking about what policy could be doing next with additional stimulus. Have you got some thoughts there?
Yeah, look, as soon as the ink dries on these stimulus checks, the Biden administration will be shifting their gaze toward infrastructure spending. This is the Build Back Better program, also worth several $1 trillion, but spread out over several years. The implications for markets and the US economy will be very different. Cash handouts to households are very important for securing a better near-term growth picture, but it's very much about boosting aggregate demand. Infrastructure, on the other hand, is more about enhancing the supply side or the productive capacity of the US economy. That's a better, longer term story for the US economy. And that's one that could actually more sustainably lift US growth prospects in the long run. And if that were to get off the ground, there's a lot of political challenges to making it a reality, but if it were to get off the ground, I suspect that would actually cast the US economy and the US dollar in a much different light. And again, if that does become a reality, I suspect we could see more meaningful shift in the US dollar's outlook. And I guess at that point, that's when we need to sort of question and think about what it might mean for the Fed, in terms of, obviously they just had their meeting overnight. And the market is consistently challenging the Fed still. Do you think that ultimately where's this going to land in terms of inflation? Do you think the markets are right here or the Fed?
Yeah, I think following the previous experience we had over the last decade, it feels like the Fed's right, or at least right to be reactive with policy. So if we think about sort of the decade following the GFC, and even the sort of intervening years between there and the pandemic's hitting the US, what we're seeing is that PCE inflation in the US has really struggled to get anywhere near their 2% target. So on that front, they are right to be reactive with policy, looking to continue asset purchases probably well into 2023, I'd argue, with a taper starting in 2022. And also really holding fire on rate increases until they see inflation at 2% and they believe that it will be above 2% on a sustainable basis for a time to make up for some of that lost ground. So for us, that does most likely put first Fed fund rate hike sort of out in that 2024 time, and that will be in keeping with what the Fed's expectations are currently. We've got 7 of 18 members looking for a rate hike in 2023, so it's not quite the consensus there. So more than likely it's that sort of next year we'd see that. Obviously, in terms of the implications for the global economy and sort of what the benefit the US might get from exports as well, the infrastructure will be a big positive there. So you've got a situation where we do need to see stronger income growth in the US if we are to see the sustaining of above-trend growth. More investment and more infrastructure there would provide that opportunity, and an opportunity to connect more with the global economy, which coming after a period of geopolitical tensions, etc., would be a very big, I guess, sort of shift into its tone, and hopefully would incentivize private investment as well, which would be another benefit for the US economy. It is still worth mentioning, I suppose, that we do believe that in those out years, so past 2021, so 22 and beyond, that the US is still likely to sort of underperform the global sort of growth cycle and the recovery there, because there is so much more development opportunity in the rest of the world. But bringing through infrastructure and investment stimulus will be a way to sort of, I guess, reduce down that deficiency and provide them with a way to run with the world and get the benefit of that as well.
Elliot, that's a really good point about the better development opportunities in Asia, and I would say from an Aussie dollar perspective, that casts the Aussie in a healthier light. It's already had an incredibly strong run in the immediate post-pandemic environment. And we would expect a better growth trajectory for Asia in the coming months and years to underpin further gains for the Aussie. And as you rightly point out too as well about the Fed outlook there, that incredibly dovish profile, that dovish glide path for policy for the next several years, that's ultimately going to cap dollar prospects, US dollar prospects, and also should underpin further sustained gains in the Aussie dollar. So the currency is knocking on the door of 80 cents. It hasn't quite broken sustainably above that level, but we certainly think the medium-term prospects for the Aussie dollar are still very healthy.
Well, thanks, Rich. It certainly is a lot to continue to think about. Well, thank you for joining us, and we'll look forward to seeing you next time.